The second biggest factor at trading after psychology is risk and money management. Of course, you should master both psychology and risk management. Without one of them, you will never become a real trader. Trading is a very risky job, and because of that, potentially trading could bring you higher rewards. The higher the risk, the bigger reward. Simple. So it is very important to have clear and well-structured risk management in order to control the situation, no matter how risky it might be. You have to have under control. I repeat myself, that risk and money management rules are golden rules and should never be broken. Remember that the discipline and conducting with the rules are key to trading success. And that is for a reason. If you start to disregard risk and money management rules, it means your capital is in danger. But your capital is pretty much everything of what your trading consists of. Why people intend to break these rules? Mostly because of psychological reasons. You start deviating from rules by thinking it's okay to disregard a bit for a bigger profit. Without thinking, that magnifies potential losses as well. And these deviations becomes bigger and bigger until it ends up with huge losses. Therefore, you must program in your mind from the very beginning that no deviations are allowed, and these rules are golden rules. Risk management involves limiting your positions so that if a big market moves or large strings of consecutive losses does happen, your overall loss will be something you can reasonably afford. It also aims to leave enough of your trading funds intact for you to recover the loss for profitable trading within a reasonable time. Risk management is the process of measuring the size of your potential losses against the original profit. Without a disciplined attitude to risk and reward, it is easy to fall into the trap of holding losing positions for too long, hoping things will turn around before eventually closing out for a large loss. Makes little sense if your original objective was to make a small profit over a few hours. Experienced traders knows that even trading strategies that have been successful over a long term can leave you vulnerable to risk in short to medium term, including significant runs of consecutive losses, occasional large losses, where price gaps through stop loss levels, for example, to a major news event, changes in market circumstances, which means that you can never be certain that just because the strategy worked in the past, it will continue to work in the future. Without appropriate risk management, events like this can lead to loss of all your trading capital or more, losses that are large to given your overall financial position, having too close position in your account at the wrong time because you don't have enough liquid funds available to cover margin, the need for an extended period of profitable and prudent trading just to recover losses and restore your trading capital to its original level. There is still, of course, the possibility that these scenarios can arise even after you have used the appropriate risk management strategies. Losing more than 30% of your account can lead to major tasks just to recover what you have lost. After large losses, some traders resort to taking even greater risks, and this can lead to ever deepening difficulties. Even after losing significant part of your portfolio, you must keep your psychology in check and focus on right things to do. To get the benefit of a winning strategy over a long term, you need to be in position to keep trading. With poor risk management, the inevitable large market move or short-term strings of losses may bring your trading to a halt. You can't avoid the risk as a trader, but you need to preserve capital to make money. A risk-managed approach to trading recognizes that you are taking risk, but need to limit that risk in short term to maximize long-term opportunities. Lack of risk management is one of the most common reasons for failure. Once again, there must be not a slightest thought about breaking your risk management. It's like an alcoholic person thinking, okay, now I'm not drinking, but maybe if there will be a certain occasion, I will take a sip. That is it. But he knows he has a problem. If he drinks, it won't be a sip. It will be continuously drinking until he reaches his bottom once again. He is alcoholic not for no reason. Whenever he touches alcohol, he has no breaks and ends up in a very nasty situations. So same with risk management rules. Once you broke the rule, you keep breaking it until you reach the bottom. Bottom could be different for each individual person, and not necessarily lose of a whole deposit. You might be quitting trading because you hustle for quite a few years and there is no progress. Risk management rules can sometimes reduce profits over a short to medium term. The temptation to abandon prudent risk management is often the greatest after a period of success, and even a single large trade in these circumstances can easily lose all your recent hard-won profits and more. It is all too common to have a lot of successful trades with smaller positions, followed by inevitable losses that comes along just when you have decided to take on a bigger positions. A consistent, controlled approach to trading is likely to be successful in the long run. Gradually compounding your account by leaving profits in account and prudently increasing your positions in a line with increased capital is more likely path to success than overtrading in the short term. Always use stop loss and take profit. We spoke about stop loss and take profit a bit. Do not ever consider to open trade without using stop loss and take profit. Take profit should be bigger than stop loss appropriately to have reasonable risk-reward ratio. Some scalping strategies don't use stop loss or take profit, just because they open and close trades in a matter of seconds, but even then it's risky. Using stop loss and take profit has many advantages, like you protect yourself from having large, unexpected loss. It also reduces the temptation to run losses in the hope of breaking even. Disciplines and consistent approach, filtering right trades, and many more. Successful trading involves balancing risk and reward. Good traders always work out where we'll cut the loss on a trade before we enter it. So first rule to have by your side, related with risk management, always use stop loss and take profit. The first thing to decide is how much capital you are going to risk per trade. Some of the factors you may wish to consider include your overall financial situation and needs, trading objectives, tolerance for risk, previous experience as a trader. Risk per trade shouldn't be relatively high compared to your capital, and you must determine ceiling, which you shouldn't cross ever. That ceiling must be percentage of your whole trading deposit. As previously discussed, this approach can have an added benefit of allowing you to trade without feeling too much pressure on your shoulders and improve your trading. Stop loss is your risk per trade, therefore, the whole calculation starts from there. Your risk per trade shouldn't be more than 1% of your whole deposit, meaning that each trade shouldn't exceed more than 1% of your whole deposit. 1% rule. Very important rule. Mark this. For example, if you started as low as 1000 euro, which is completely fine, so your risk per trade would be 10 euro, which is not that big, right? I'm pretty sure you can afford to lose 10 euro per trade, and that wouldn't affect you. Even after 10 losses, for example, your loss would be 100. Run from people who says to use 5 or even 10% per trade. That is nonsense completely. You will be wiped out very quickly. 1% is maximum that you can use at the beginning. By using 5%, after 10 losses you lose half of your deposit. And that can really happen. Losing strikes happens even for experienced traders. And to lose half of your deposit won't be that comfortable in any case. Those who saying to use 5 or even higher percentage are not traders themselves. Definitely. When you will be successful and experienced trader, you can let yourself to use 2 or even 3% occasionally. But at this point, you need to know 1% rule and never consider to break it. Experienced traders are familiar with financial markets quite well, and they know what to expect and where they can increase risk for a bit. But even then, they're doing everything systematically. Worth to mention that some trading platforms allow you to set fixed percentage positions, meaning that platform automatically set loss of your set percentage. That might be a helpful tool. Your position automatically becomes smaller if you suffer losses, helping to preserve your trading capital. But if your platform doesn't have that function, it's completely fine to do it by your own, and it doesn't require too much effort. If your deposit is 1000, then your loss for any given trade would be 10. Measure that number in relation with point numbers and worth per point in any given market. After quite significant change, recalculate it to make sure your trading capital grows steadily while maintaining the same percentage risk levels. After deciding how much you can risk per trade, you should be able to calculate your stop, quantity of points that market can move against your favor. There are two types of stops, fixed stop and technical stop. Fixed stop is maximum stop possibly can be, and varies in each market. Another is technical stop, which is based on chart analysis. Fixed stop in different markets is ever so slightly different. Fixed stop is based on market size, volatility, and expectations. These are factors to consider for fixed stop determination. At futures, indices futures, crypto, mutual funds market, fixed stop is 0.2% value of the market. For example, let's consider that Nasdaq's 100 futures market is traded around 18,000 price level. Then 18,000 divide by 100 and multiply that number by 0.2% equals 36 points. Or you can simply divide 18,000 by 500 because 0.2% is one part of 500, meaning that 36 points is absolutely maximum stop that you can set for any given trade. Of course, in a way, when market price changes, for example climbs to 19,000 or drops to 17,000, you must recalculate your stop and use updated one in order to keep the same risk. But do not recalculate your stop every 200 points of change. Sometimes, market moves in one day more than that. Make changes only after significant change. Another example, gold futures price is roughly 2,400. Then 2,400 divided by 500 equals roughly 5 points. But it is very important to consider average price change and volatility of a market. For example, in gold market, average price change are not that significant as in indices futures market. Therefore, in such market as gold futures, to keep lower stop would be a better idea. If situation allows, of course. Also important to mark that these kinds of stops are used to day trading, or at the most swing trading. If you're holding your trade more than few days, stops must be appropriate as well. At forex market, fixed stop not more than 30 points. At stock market, fixed stop falls into several categories. For stocks which value is under $10, fixed stop would be from 10 to 25 cents. For stocks between $10 and $100, fixed stop would be from 25 cents to 75 cents. And for stocks which value is above 100, fixed stop would be from 50 cents to $1.5. As it was mentioned already, for fixed stop determination, you must consider market volatility, movements, price itself, etc. It is obvious that stocks which value is under $10 moves way less than those above 100. Therefore, expectations must be lower as well. But it doesn't mean that you cannot take the same amount of profit. Remember trade calculation. When it comes to fixed stop determination, especially at stock market, keep in mind that fixed stop shouldn't be more than a third of your ATR. If fixed stop is more than a third of your ATR, your fixed stop is not correct. Another type of stop is technical stop. Technical stop must be attached on something at the chart. It could be last pick up or down, previous price test of area, etc. The thing is that price must be attached on something on the chart based on technical analysis. Let's get to the chart for an example. It is Dow Jones 30 futures market at 5 minutes time frame. Currently, market price is above 39,600. Accordingly, our stop is 80 points. We are planning to go long if price crosses this red line. Of course, we are planning our stops ahead, just to be prepared. We notice that on the left there is a peak down below our red line, on which we can attach our stop, roughly 60 points below. Our stop at this specific example would be 60 points, which is obviously less than fixed. Do not ever consider to disregard fixed stop. It is maximum that market can move against your favor, period. Fixed stop is your 1%. If your fixed stop is 30 points, for example, then value for these 30 points 1% of your deposit. Another rule, use technical stop as much as possible. The smaller the stop, the more chances of positive trade. Simple. Your take profit will always be based on your stop. And if your stop is less, then appropriately take profit would be less accordingly. There will always be greater possibility that your target will be reached if you keep lower expectations. Of course, there are situations when it is not possible to use technical stop. Then we use fixed. But whenever you have chance to use technical stop, use it. In the long run, you'll benefit from that, rather than points you could take by using fixed stop. Long-term trading profit can be described as a winning combination of the number of profitable trades compared with the number of losing trades, the average value of profits on each trade compared with the average value of losses. It is important to combine these ratios and the relationship between risk and reward. For example, many successful traders actually have more losing trades than winning. But they make money because the average size of each loss is much smaller than the average profit. Others have a moderately average profit value compared to losses, but a relatively high percentage of winning positions. Therefore, first rule in the relationship with take profit, 1-to-3 ratio rule. Another very important rule, and not breakable. This rule means that your stop equals to 3 times of stop value into profit, meaning take profit equals to 3 times stop value. For example, you set your stop loss at 20 points, then accordingly your take profit would be 60 points, which is 20 times 3 equals 60 points. It is also one of the golden rules and never should be breaked. This rule gives you advantage to keep yourself profitable even having more losses than winners, meaning one positive trade covers 3 losses. Let's say you had 7 trades of the day and 5 of them were negative, which is a really bad trading day. Only 2 of those were positive. Let's say all of those trades was with 20 points of stop loss. Your profit would be as follows. 2 times 20 times 3, our positive trades, minus 5 times 20, our negative trades, equals 20 points of profit. Isn't that amazing? After so many losses, you still remain in profit. And it is just one trading day, which is not that great anyway. If it would be full futures contract of Nasdaq 100 market, for example, where each point worth $25, your 20 points of profit would be worth $500. With not so good trading day, end up in not that bad profit is really nice. This ratio also helps psychologically to stay still even after quite a few losses, because you know that one positive trade will cover the last 3 losses. To stay even, you need to have only 25% of success rate, meaning that 1 of 4 trades must be positive. Is that so hard? I don't think so. Especially when you do everything systematically, using quite a few analysis sources, based on facts with clear expectations, is really not that difficult. However, it takes time to get used to it. All you need at the beginning is to follow rules, be consistent and disciplined. To have success rate of 45 to 50% is very good. You will gain a lot of money in your trading account with that kind of success rate. After practice and some experience, you can expect to have success rate close to it. From the very beginning, by following rules with no emotional trades, you can expect to have success rate between 30 to 40%. Let's take average, 35%. Let's say you made 100 trades per month, with same 20 points of stop loss and 60 points of take profit. 35 of those trades were positive and 65 were negative. Means you made 60 times 35 minus 20 times 65 equals 800 points of profit by having 3 positive trades of 10 on average. This is beauty of numbers and the right risk management. Chances of trade to be positive is lower than negative trade. That's why, in first place, you have more losses than winners. And your job as a trader is to do any means necessary to increase those chances. Second important rule of take profit: never adjust take profit rule. If there are some rules of adjusting stop loss, which ones we are going to discuss in a moment, with take profit adjustment, there are no any exceptions. You need to keep it as it is, no matter what. There will be times when to take profit needs just few points, but price turns around and moves to stop loss. No one knows when market going to turn around. It might go 1000 points after opening trade into profit, or just few and went to loss. Everything can happen. Thoughts like, it is already there, need to close it before it's not too late. Profit is already really huge, that is not for me, need to close, are toxic. There is your greed and psychology speaking, but not logic and consistent part of yours. Only one thing you can do is to close your trade when you receive a signal in opposite direction or before key times, to protect yourself. 1-to-3 ratio rule: minimum risk reward ratio you can take, but you can take bigger ratios like 1-to-4, 5, or even 10 if opportunity presents itself. It's always good to have bigger ratios, but technically there must be space for bigger ratios, meaning there must be no any support or resistance areas or anything else that might indicate potential price reversals or indecisiveness. That also applies to 1-to-3 ratio rule. If there is no space to take appropriate profit, do not open trade. There must be appropriate range that allows you to take your profit. Otherwise, you are trading against expectations and strategy, and trade shouldn't be opened. Let your profits run rule. Do not worry about open positions and what might go wrong with it. You made your analysis, rules by your side, technical aspects as well. There are no any economical events or key times near. Leave your trade. Do not focus on current profits. You have your target. That is also a psychological thing. We are triggered by upcoming profits, and that might influence our actions. You must work on those triggers, and do not let yourself to get emotional. Let your profits run, and do not focus on money. You can even hide window with account balance, open positions, and profits within, if it helps you. Stop adjustment. There are some rules of adjusting your stop loss, as we spoke about. 2 stops moved into take profit. When price moves to take profit in size of 2 stop loss, you can adjust your stop loss to 0 or to small profit. If your stop was 20 points, then if the market moves to take profit for 40 points, you can adjust your stop to 0 or few points into take profit. But if you intend to do this, you must do it systematically. It would be quite a few zero trades, but in the long run, you will gain more than you lost on this rule. Or it might be bringing negative impact, but I doubt that. Anyway, the recommendation would be to apply this rule. To adjust stop loss when price moves 1 stop loss into take profit, it's too early just yet, and statistically brings negative impact. Before key times. Before any economical event or any other key time related with the market, you can adjust your stop loss to 0 or to close your position. Especially if small loss, better close trade before key time and accept that small loss to avoid slippage. If economical event is huge and usually has huge impact on financial markets, it is also recommended to close your position. If it turns against your favor, even with adjusted stop, you might receive significant loss. Of course, price might jump to your profit target, but it is a risk you take, and that kind of risk is not tolerated at trading. Signal in opposite direction. When you receive signal in opposite direction, you can either close your position or adjust stop loss into no loss. At the beginning, the recommendation would be to adjust your stop into no loss, just because you have no experience just yet, and you don't know how powerful that signal is and what usual impact it brings. After a while, with experience and gather statistics, you can close your position when you know for sure that appropriate signal has huge impact on price chart. But at the beginning, the recommendation would be to adjust your stop into no loss to protect yourself. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.